Hello, and welcome back to At Your Pace Online's Michigan Real Estate Education Series. In this portion of the class, we'll be discussing mortgages. We'll start off with an exploration of mortgages, with a special look at how they differ from deeds of trust. Following that, we'll discuss federal and state legislation that relates to mortgages. A large portion of loans for the purchase of real estate are secured with mortgages. This specific type of loan will be encountered regularly by real estate professionals. For this reason, it's critical for you to understand the characteristics of mortgages. It'll make you more effective in guiding clients when they're obtaining the money to purchase real estate. While the overall financing process is fairly straightforward, it does have several important steps. The buyer's ability to finance the property is an important contingency in most residential transactions. Buyers must act in good faith and use best efforts to obtain a loan if the sale is contingent upon obtaining a loan. Buyers often seek pre-approval from a lender before making an offer. A pre-approval letter should state that the lender has reviewed the buyer's credit report, income requirement, and cash to close. The letter will also state whether the lender has pre-approved the buyer for the loan. The pre-approval may be subject to an acceptable appraisal of the property. The appraiser will normally work for the lender, not the buyer. Once the appraisal has been received, the underwriter will authorize final loan approval. Only when the underwriting process is completed will an actual loan be secured. The entire financing process normally takes between 30 and 45 days. A mortgage by itself doesn't represent the debt incurred by taking out the loan. Rather, the mortgage is the interest in the property that is used to ensure that the borrower won't default on the loan. It's the mortgage that allows the lender to lay claim to the property in the case of a failure to repay. A promissory note is the portion of the mortgage loan contract that obligates the borrower to pay back the money loaned. A failure on the part of the borrower to repay the loan allows the lender to invoke the mortgage and initiate any foreclosure procedures that follow. In some states, the security for a mortgage loan is a lien on the property the mortgage finances. In other states, the title is held by the lender until the mortgage loan is paid off. Either way, the lender may attempt to claim the property should the borrower default on the loan. Foreclosing on the property is done to regain ownership of the property. If the foreclosure is successful at a later date, the property will be sold off in an attempt to make up the unpaid loan amount. Lenders can establish some protection from losses caused by a default on a loan by obtaining mortgage insurance. Mortgage insurance is a type of insurance policy that reimburses a lender if a borrower defaults on a loan. The Federal Housing Administration and the Veterans Administration insure groups of loans for qualifying borrowers. Private companies also offer insurance for mortgage contracts. Mortgage insurance is usually required for any mortgage loan that covers more than 80% of the purchase price of the property. The borrower is commonly the party that buys the mortgage insurance, even though it actually protects the lender. When a mortgage is insured, lenders are often more flexible with the required down payment, sometimes allowing the borrower to acquire the property for as little as 3% down. The amount that the borrower owes for the insurance policy is usually dependent on the size of the down payment. A typical cost is 0.5% of the principal. It's rare for someone to buy a property with cash in hand. The vast majority of real estate purchases require the use of some amount of borrowed money. If you work on a real estate transaction, you'll probably interact with money from a mortgage loan. The mortgage loan is one of those fundamental concepts that you'll need to adequately understand to be successful. We've established the foundation for understanding the financing process and where mortgages fit in. We can now look in detail at mortgage loans.